On the morning of Monday, September 15, 2008, Lehman Brothers employees arrived at the firm's Midtown Manhattan headquarters carrying cardboard boxes. They had been told the night before. The firm was filing for bankruptcy. 158 years of history. The fourth largest investment bank in the United States. Gone. The filing listed $639 billion in assets and $619 billion in debt. It was, by an enormous margin, the largest bankruptcy in the history of the United States. Nothing before it had come close. Within hours, stock markets around the world began to fall. The Dow Jones dropped 504 points, its largest single-day decline since the attacks of September 11, 2001. Credit markets froze. Banks stopped lending to each other because nobody trusted anybody's balance sheet. The entire global financial system, built on a web of interconnected obligations and mutual confidence, began to seize. The Lehman collapse did not cause the 2008 financial crisis. The crisis was already underway, the result of years of reckless mortgage lending, fraudulent securities, and catastrophic regulatory failure. But Lehman's collapse was the moment the crisis became visible to everyone. It was the moment the abstraction became concrete. Before September 15, 2008, the crisis was something happening in financial markets. After it, the crisis was something happening to the world. This is how one firm, 158 years old, one of the most respected names in American finance, became the symbol of the worst financial catastrophe since the Great Depression. Lehman Brothers was founded in 1844 by Henry Lehman, a German immigrant who opened a dry goods store in Montgomery, Alabama. Henry's brothers Emanuel and Mayer joined the business, and the firm gradually shifted from commodities trading to financial services. It helped finance the cotton trade in the post-Civil War South. It moved to New York. It survived the Panic of 1907, the crash of 1929, and the Great Depression. It survived the oil crisis of the 1970s and the savings and loan crisis of the 1980s. In 1994, it was spun off from American Express as an independent firm and immediately began growing into a major force in global investment banking. By 2007, Lehman Brothers had revenues of $59 billion and was regarded as one of the most sophisticated financial institutions in the world. It had 28,000 employees in offices across North America, Europe, and Asia. Its stock had risen more than 700% since its 1994 spin-off. The firm had survived everything the 20th century had thrown at it. The idea that it would not survive the 21st was to many people who worked there and many people who watched it from outside genuinely unthinkable. But survival had always depended on not making catastrophic bets. And in the middle of the 2000s, Lehman made a catastrophic bet. In the early 2000s, something extraordinary was happening in the American housing market. Home prices were rising. Banks were lending money to people who wanted to buy homes, including people who, by any reasonable assessment, could not afford to repay those loans. The loans were then bundled together, repackaged as securities, given ratings by agencies that did not understand what they were rating, and sold to investors around the world who believed they were buying safe assets. This was the subprime mortgage machine. It generated enormous fees at every stage of its operation. Banks made money originating the loans. Securitization firms made money packaging them. Rating agencies made money approving them. Investors made money buying them, for a while. Lehman Brothers did not invent this machine, but it embraced it with more enthusiasm than almost anyone else. Under Chief Executive Richard Fuld, Lehman expanded aggressively into mortgage origination. It bought subprime lenders. It accumulated enormous positions in mortgage-backed securities. It held on to large portions of the securities it created, believing it was getting something for nothing, the fees from creating the securities plus the returns from holding them. By 2007, Lehman was the largest underwriter of mortgage-backed securities on Wall Street. It had more exposure to the American housing market than any other major bank. And the American housing market was about to collapse. There is a concept in finance called leverage. It refers to the use of borrowed money to amplify returns. If you invest $1 of your own money and borrow 9 more, you can make 10 times the profit, but you can also absorb 10 times the loss. At the peak of its mortgage exposure, Lehman Brothers was leveraged approximately 30 to 1. For every dollar of equity, the firm's own money, it had borrowed and invested $30. At that ratio, a 3.3% decline in the value of its assets would wipe out all of its equity. The firm would be insolvent. In 2007 and 2008, American housing prices did not decline by 3.3%. They declined by much more, in many markets, over a sustained period. The mortgage-backed securities that Lehman held, assets that had been rated AAA, the highest possible investment grade, turned out to be worth a fraction of their stated value. Lehman's response to the growing crisis in its balance sheet was, for most of 2008, to deny it. Richard Fuld told analysts and investors that the firm was well capitalized. The firm used an accounting maneuver called Repo 105, later found to be misleading, to temporarily move assets off its balance sheet, making its leverage appear lower than it was. The market was not persuaded. Lehman's stock fell 73% between January and September 2008. Short sellers were betting against it. Counterparties were withdrawing. The firm was hemorrhaging the confidence that investment banks depend on to operate. On Friday, September 12, 2008, the Treasury Secretary of the United States, Henry Paulson, convened a meeting at the Federal Reserve Bank of New York. The assembled group included the chief executives of every major American financial institution. The subject was Lehman Brothers. The firm was days from collapse. 2 potential buyers had expressed interest: Bank of America and Barclays. Both were conducting due diligence over the weekend. Paulson made clear that the United States government would not provide financial support for a Lehman rescue. There would be no bailout. Over the next 48 hours, both potential rescues collapsed. Bank of America concluded that Lehman's losses were too large and too uncertain. It pivoted instead to acquiring Merrill Lynch, another firm that was days from collapse, in a deal announced that same weekend. Barclays was willing to proceed, but required a guarantee from the United States government to cover potential losses. Paulson refused. Without the guarantee, Barclays' own shareholders would not approve the deal. The British government declined to waive the regulatory requirement for a shareholder vote, which could not happen quickly enough. The deal died. By Sunday evening, there were no buyers and no government rescue. The outcome was inevitable. At 1:45 in the morning on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. Richard Fuld was not in the building. The immediate aftermath of Lehman's bankruptcy was unlike anything the modern financial system had experienced. Lehman had counterparties, institutions to whom it owed money and from whom it was owed money, in virtually every corner of global finance. When it collapsed, those relationships froze. Contracts that had seemed certain became uncertain. Assets that had been valued against Lehman's obligations had to be revalued. The daisy chain of mutual confidence that keeps financial markets functioning snapped. The Reserve Primary Fund, a money market fund, the kind of account that millions of Americans use for savings, announced that it had suffered losses on Lehman securities and that its share price had fallen below $1. This was called breaking the buck. It had happened only once before in history. Investors began pulling money from money market funds across America. Within days, $1 trillion was withdrawn. The Federal Reserve, which had declined to save Lehman, found itself spending the following weeks in an emergency operation to prevent the collapse of the entire system. AIG, the insurance company, received a bailout of $85 billion. Washington Mutual failed. Wachovia was rescued. The government put Fannie Mae and Freddie Mac into conservatorship. The week after Lehman's collapse was the closest the global financial system had come to total failure since the 1930s. In the years since 2008, a question has never been fully resolved. Did the government have to let Lehman fail? Paulson and the Federal Reserve Chairman Ben Bernanke argued that they lacked the legal authority to rescue Lehman without a willing buyer. The Fed could lend against collateral, but Lehman's collateral was of uncertain value. Without congressional approval, which had not yet been granted, a direct government investment was not possible. Critics argued that this was a choice, not a constraint, that the government had rescued Bear Stearns 6 months earlier, that it would go on to rescue AIG, Citigroup, Bank of America, and dozens of others, that it had the will to save every institution except Lehman, and that the decision not to save Lehman was either a miscalculation of the consequences, a moral judgment about Lehman's behavior, or a political decision that the optics of another bailout were unacceptable. Whatever the reason, the decision had consequences that no one had fully modeled. The crisis that followed Lehman's collapse cost an estimated $10 trillion in lost economic output globally. It put 30 million people worldwide out of work. It triggered recessions across the developed world that, in many countries, lasted years. The effects on household wealth, on pension funds, on small businesses, on ordinary people who had nothing to do with mortgage securities were enormous and lasting. Lehman Brothers was not the cause of the 2008 financial crisis. The cause was a system that rewarded short-term profit over long-term stability, that allowed banks to take risks they did not understand with money that was not theirs, that was overseen by regulators who either could not or would not intervene. Lehman was the biggest participant in that system. It was also, in the end, its most prominent victim. Richard Fuld, who earned more than $500 million in compensation during his tenure as chief executive, was never charged with a crime. No senior executive of any major financial institution was imprisoned for conduct related to the 2008 crisis. The firm that had survived 158 years, 2 world wars, the Great Depression, multiple financial panics, was undone in less than a decade by a strategy that prioritized the appearance of growth over the reality of risk. In 2010, what remained of Lehman Brothers was sold off in pieces. The investment management business went to Neuberger Berman. The North American operations were acquired by Barclays, the same firm that had declined to rescue it 2 years earlier, and that bought its assets at a fraction of their former price. The cardboard boxes outside 745 7th Avenue on the morning of September 15, 2008, contained the personal effects of 28,000 people who had come to work at a firm that no longer existed. The money that had flowed through those offices for 158 years did not disappear. It went somewhere. It just wasn't there anymore.